Good afternoon and welcome back everyone to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, another day in the grip of the bears on the Lal Street as we head for the second straight week of losses. After almost 5 to 6 straight weeks of gains, it seems like the tide is slowly and steadily turning against the bulls. If you look at the Nifty and Sensex, they are looking set to end lower for the third consecutive session. Also, very interestingly, the selling pressure seems to have now stretched to the mid and small cap space. Santo, I think if you look at the mid and small cap space today, it is really a telling sign that the Nifty mid cap index is actually down about 1.5%. So clearly a lot of pressure emerging there, and I think that makes you wonder whether the recent bout of outperformance that we had been seeing from the broader market, whether that is probably coming to an end.
Well, I think CJ, when the pressure in mid and small cap could partly be explained due to the fact that there could be a lot of margin requirement related selling. So what happens is whenever prices come off, the traders who have exposure to these stocks need to put up more margins with the brokers, and if they are unable to put up those margins, the brokers simply square off the position. So that margin related selling is something that we could be seeing in the case of second line shares such as mid caps and small caps. But that said, CJ, this was something we had been discussing in the morning also. The buy on drip strategy seemed to be working briefly in the afternoon when you saw the indices make up for most of what they had lost.
Yeah, almost at one point of time, Sensex was actually in the green territory, but that hope only lasted for a few minutes.
Probably if this selling pressure in second line shares intensifies further, then you might have bulls getting a little more
absolutely,
cautious.
because we have to always remember that when it comes to investing in the middle small cap space, is always about sentiment more than about your positioning, because in mid and small cap stocks, illiquidity is a major issue, and those kind of stocks tend to move more on sentiment, where you will see almost at one go there will be a lot of sell orders, or in one go there will be a lot of buy orders. And I think that if we are seeing a lot more sell orders today than buy orders, that clearly is an indication that the overall optimism around the market is maybe becoming or receding or becoming thinner and thinner as the day goes by. Also, I think a very nice analysis also came out from Reuters actually earlier today, wherein basically the report said that the Santa rally has now gone out of the window, because Federal Reserve or the central banks will just not budge on the peak inflation and the peak rate scenario that the market had been rallying on the past 3-4 weeks. That has not come about after this week of central bank meetings. So I think now a lot of traders will start questioning that there are no triggers right now, right? For the next 2-3 weeks till we have the earnings season, there are no really triggers to make these stocks continue to rally, and therefore a lot would be choosing to profit book.
Well, I could argue it the other way around also, CJ, that because you won't see much of institutional activity for the next couple of weeks, maybe local traders, operators would be emboldened to kind of try and put up the prices, because let's not forget, getting out of these stocks, to get out of these stocks, probably you will need these volumes need to be pretty good, and if the stock price continue to fall, you'll see liquidity also dry up quite fast.
Absolutely,
so
absolutely.
I think maybe operators will have another stab at
maybe,
the second
because
line.
participation levels will go down over the course of the next 2 weeks. You will have institutional activities definitely coming down, especially from the FII side, because their holiday seasons will begin from this weekend onwards and will continue probably till the first weekend of the new year. So very interesting times. It will be interesting to see how the smaller mid-cap space develops or evolves going ahead. But at this point of time, things clearly are not looking that pretty.
Well, a quick take on the FNOQs. Now we are seeing short build-up in polycap, that those futures have been seeing consistent build-up in short positions for the last few days now. Tata Chemicals and Dr. Reddy, we'll be talking about Dr. Reddy at length in a few minutes from now. And we're seeing long build-up in Balrampur Chini, PI Industries and Abbott Industries.
Well, thank you. Well, thank you for those FNOQs. And now moving on to the stocks that were buzzing in trade today for us, and 5 of them, and the first one is from the tire space.
Yes, Apollo Tyres. Now the stock has been consistently rising for the last many weeks. Now the big key trigger for tire stocks in general is the easing of raw material prices. That's been the biggest overhang for tire companies, though the sales were doing well because of high input costs. That was not really reflecting in the profit margins, but that now seems to be set to change right now. And in the case of Apollo Tyres, what sets it apart is that the company has been able to maintain the prices at higher levels, and the company management in a recent interview to the channel said that the outlook for the second half of this year continues to remain strong, and it's looking at a margin of 12% for the India business, and Europe is another key market for Apollo Tyres. The situation there is the general concerns there was that because the Europe is facing a slowdown, you could see most of the industries are getting hit, but that has not been the case, at least so far, according to the management. And lastly, the launch of the Redstream brand in India, that has got a good response for Apollo Tyre so far, which right now seems to have close to about 42% share of the ultra high performance tire segment.
I think, Santo, for me, of course, one of the most key reasons for the rally that we have seen in Apollo Tyres is the softening of commodity prices, especially on crude oil and rubber prices, which are very, indirectly linked to each other because rubber is almost a derived product from crude oil. But I think if you look at the outlook for crude oil, recently Moneycontrol did a survey of a lot of economists and traders from the oil market, and they are expecting oil prices to go back to $100 per barrel by the end of first quarter of 2023, that is the March quarter. So if we do see a reversal in prices of global crude oil prices, I think that could play a bit of a spoil sport as far as the margin recovery story is concerned with Apollo Tyres. Also, let's not forget, we talked about this on the show last week, that volumes for small passenger vehicles as well as for two-wheelers, mass market two-wheelers, is struggling at this point of time. And if that comes out to be true or continues going ahead in the fourth quarter as well, then you could see that clouding the outlook as far as volumes are concerned for Apollo Tyres. So I would not say everything is hunky-dory at this point of time. I think some grey clouds are now beginning to emerge on the horizon as far as Apollo Tyres is concerned. Moving on to the first stock on my radar today, and Dr. Reddy's, as we mentioned earlier, we will be addressing this stock. Now the stock is down about 5% today. There are a couple of factors around it. Of course, one is the reject that we are seeing in the Sensex, wherein Dr. Reddy's will now be kicked out of the benchmark index.
That's a very harsh term there.
It is what it is, Santo. It is what it is.
But let's not forget, stocks which are welcomed into the index,
they actually tend to do better once they're.
No, they also get kicked out at some point.
It's the reverse. But do you know, it is actually a very funny statistics that when a stock enters a benchmark, it starts to underperform. And when the moment the stocks gets out of the benchmark, it starts to outperform everybody else. So yeah, that is always there. But at this point of time, it's been escorted out of the benchmark index, if I may put it that way. And of course, Tata Motors has been welcomed in or will be welcomed in, and therefore you're seeing some bit of selling pressure coming in from ETFs which are benchmarked to the BSE Sensex. But apart from that, another key reason for the downtick today is the fact that the company's arm, an oncology arm which works on oncology drugs, they were conducting certain trials for a drug which was supposed to work on moderate to severe psoriasis patient. Now that drug trial has been halted because of inadequate result or the drug not providing desired improvement in moderate to severe psoriasis patients. So that should be a setback for Dr. Reddy's ambition as far as the oncology treatment space is concerned, because if this drug would have been successful, it would have definitely aided to the company's sales outlook as well as margin outlook going ahead, because this would have been a limited competition product and that would have been quite a blockbuster drug as far as Dr. Reddy is concerned. So a bit of a setback on the fundamental side there, and of course on the sentiment side, as I mentioned, the reject on the Sensex is also taking a toll on the stock's performance.
Well, no doubt, CJ, that development has come as a bit of a bolt from the blue, but let's also not forget hits and misses are anyway part of the drug development process. Some work, some don't. But if you look at the overall picture now, the stock has gained close to about 20% from the lows that it had seen in March this year, and the second quarter numbers, that is something that really seems to have really changed sentiment for the stock overall, and the management commentary after those earnings were also pretty positive. Now the big kicker had come from the sales of generic Revlimid, which the company is hopeful of sustaining in the at least for the next couple of quarters as well. And also this is something that you've always been saying, that the pressure in the US market. Now there was some bit of pressure, but it was not out of the ordinary. It was pretty much in line with what the company had anyway been factoring in. That's the other thing. You got strong India business as well. Excluding COVID, the India business had grown by close to about 20% during the quarter gone by, and the company again is quite hopeful out there as well. Besides that, the company has guided for a double-digit revenue guidance for the current year, which it is stuck by, and it has also said that it's comfortable with guiding for 25% EBITDA margin. So, a lot of things happening out there for Dr. Reddy. We've seen a lot of drug master files being filed for, a lot of abbreviated new drug applications being filed for, new product launches. All those things are also happening. So, I think CJ, on the whole, if you take the notwithstanding, yes, this development certainly is a negative, but if you look at the other things put together, definitely things appear to be much better for Dr.
Well,
Reddy.
Santo, I salute your optimism there.
Well, Engineers India is the next stock here. Now, the stock has been steady again in a choppy market. It continues to do well. Good comeback by Engineers India. It had been underperforming for a very long time. So, what has really changed for the company? One is that the pace of execution now seems to have definitely picked up, and the order book is also pretty robust at this point in time. Even as the execution was a little slow over the last many quarters, the order book had been steadily building up. That had risen to close to about 8,430 crore. Now, in the first half of this year, Engineers India has done about got orders of about close to about 800 crore, but the company has said that for the full fiscal, they will the order wins that they expect is closer to about 4,000 crore. So, a lot of
really optimistic there. A lot of
pending orders, you know, with PSUs, a lot of those things are finally now coming through. And besides that, anyway, you have the good dividend yield. Besides, also the company's valuations at current level, just about 13 times 1 year forward, is also fairly reasonable. So, a lot of things going in for Engineers India at this point in time, which is why you saw the rally from close to from what 59 odd levels to about 82 levels. That's a big jump indeed. Again, if you look at the quarterly numbers also, 47% year-on-year growth in its turnkey revenues, which is again the highest in a very long time. 21% growth overall year-on-year. That is also after many quarters.
Well, Santo, I think the only thing that makes me a little skeptical is the entire business to government sort of approach that Engineers India has. Now, as you mentioned, of course, PSU order wins have been delayed, and that is why that is the reason why the company only has 800 crore worth of order inflow this year, but it's expecting 4,000 odd crores by the end of this year. Now, that is a big way to go. And
leap of faith?
Yeah, I mean, that is you will have to take a leap of faith as far as.
But the stock price is clearly indicating something.
Yeah, exactly. I think that is also, it is also riding the entire wave that we are seeing in B2G companies in the market, especially with many of the big HNI names such as Ashish Kacholia at all buying stake into a lot of these sort of business to government sort of companies. But with these companies, the risk is always that the government can, of course, delay order tenders. They can delay payments. That leads to plays a lot of havoc with your cash flows as well as balance sheet. And I think that is one of the reasons why the 13 times earnings that you're seeing, price to earnings that you're seeing, I think that multiple is justified, because the market will not give you premium multiples because it's not as certain as it is, say, for example, in any other business to consumer or a business to business sort of a business model. So for me, I think that is where the risk lies for Engineers India. Also, I'll take your word that outlook does appear quite solid, but if you look at the stock from a technical point of view, I think there is some bit of probability appearing now that the stock may enter a consolidation phase. It has seen a stellar rise so far in the past 6 to 7 months, but with such a large amount of gains coming in such a short period of time, you tend to see that some bit of time correction tends to creep in. And I would not be surprised if this stock, probably ahead of the budget, either it could shoot off even more from here, or it can just consolidate a little bit before investors wait to see what the budget has to hold in terms of public capex, and then maybe take another call or relook on the valuations of Engineers India. The last stock on the radar today for me is ONGC. Now, very interesting update coming in for ONGC in the sense that the government has very sharply cut the windfall gains tax on for the company's crude oil production. Now, it seems like the overhang of the windfall gains tax is clearly receding on the stock, even though it is coming at a time when crude oil prices are falling, which generally would be assumed is a negative for ONGC. I think this cut in windfall gains tax will definitely aid the Q3 earnings for the company. I think it will provide a little bit of buffer as far as sequential earnings are concerned. But I think the outlook on average realization still does not change for ONGC, in the sense that even though oil is in the territory of about $75 to $80 per barrel, I think clearly the company at this point of time can easily make $70 to $75 per barrel, but the stock price is only factoring in about $40 to $45 per barrel, which is a gross mispricing that a lot of analysts have been talking about. So something has to give as far as ONGC is concerned. Either the investors have to be proven wrong, or the fundamentals of the company at this point of time have to be proven right, and we will have to wait and see whether that up move or that potential re-rating that a lot of analysts are betting on comes through for ONGC.
Well, no doubt this is a positive development, and as you said, it will probably reflect in the third quarter earnings also. But CJ, the thing is that the company always seems very susceptible to sudden changes in government policy regarding the oil and gas sector. Now, on one hand, it's benefiting from the oil side of its business, but if you look at the gas side of its business, that is where a price cap has been proposed. Now,
it has been proposed.
Yes, that may come through or may not come, but most likely it may come through because you have the ordinary citizens.
Inflation is a major issue there.
So that said, there is no clear trigger for ONGC at this point in time, because the benefits somehow seem to be evenly balanced. What it's gaining on the oil side probably seems to be going away on the gas side. So that is something that makes me a little skeptical about the stock at this point in time. Yes, I do agree. The dividend yield is pretty good for the stock. There are certain supports in place, but as always, this has been more of a better tactical bet than something that you need to hang on. I
think Santo, you can clearly see it as a tactical bet, especially with that dividend yield in play. I think with that dividend yield in play, if you even do not see large scale appreciation in your capital, I think if you see moderate, say, market sort of performance from ONGC on top of that dividend yield, then it really makes the stock a very attractive play given the current environment and the current level of uncertainty that we have in the stock market. Well, moving on, Santo, before we should actually take a check on the market before we take some of our viewer queries. So go ahead with it.
Well, it looks like we are going to end fairly deep in the red.
We have actually seen more losses now since the time we started talking.
Yeah, and Bharti Airtel among the prominent losers, down 0.5%. Nifty is down 144 points as we speak. The Sensex down by about 429 points. So the midday bounce or the buy on dips kind of approach did not really work.
Not coming through at all, and we have broken below the 18,400 mark quite comfortably now for the Nifty, now actually below at 18,300. So that 18,200 support that you were talking about in the morning, Santo, I think that will come into play next week when you open for trading. You'll have to wait and see whether we go even below that, and then maybe you have 17,800 coming into play, or maybe market will finally find support there and you could see some bit of consolidation there. But the broad and small, the mid and small cap space also in focus. You're seeing clearly a lot of selling pressure there too. The Nifty mid cap index, small cap index down about 0.7, mid cap index down about 1.6. The biggest loser today is the mid cap space. Also, if you look at the VIX index, I think if we can have the chart up, there also you're seeing a decent amount of gains. The India VIX index, or the fear gauge as it is popularly known as, up about 2.5% in trade. So overall, pretty bad close to the week, it seems, Santo.
Well, and the key things to keep an eye out for, CJ?
I think, Santo, of course, there is not much in terms of economic data or events happening next week. I think a lot of it had happened this week, so therefore it's a light week in terms of events and economic data. But a few things that investors could watch out for is the US existing homes as well as new home sales next week. That data will be coming out next week. Also, the RBI's credit growth data will be coming out later in the evening, so that could have some impact on the banking stocks performance next week. So keep an eye out on those two things.
Well, and
we wanted to so one of our viewers, Santo, wanted to know that whether the recent buying that we are seeing from mutual funds in new age tech stocks, would that be an indicative of some future growth coming in for these companies?
Well, all businesses, CJ, now I don't know, those would be specific stocks that the mutual funds.
Yeah, I think the four stocks that I've seen buying were the four stocks whose lock-in period ended last month. These are Delivery, Nykaa, PB Fintech and Paytm. So these four stocks where mutual funds were actually net buyers in the month of November.
So it could be that some of these mutual funds may already have have had some existing positions at higher levels. It could be that they may be trying to average that. Secondly, very possible that mutual funds might have taken a slightly opportunistic approach. They have seen that whenever there are sharp declines, you also see sharp pullbacks. So it could be a short-term bet as well. And thirdly, there is a price at which every business starts to look attractive.
Yes,
and
absolutely.
after the sustained fall over the last many months, and some of these companies, if you look at Paytm, PB FinTech, they have given some very positive commentary there in terms of achieving operating profits, the timelines that they have set for it. In the case of delivery, some analysts now suddenly have taken the view that the problems that the company is facing, they are not really structural, they are more of transient. Now, the e-com side of the business took a bit of a beating. That is where the company had also warned of given a
in the case of delivery, I remember this very interesting headline of a report on the stock which said, good company in a bad time.
Yes. So it varies. It's very hard to say, what are the reasons for which the mutual funds could be buying. It could be any of the three reasons that I've mentioned.
Yeah, absolutely. I think, Santo, on that note, we can wrap up the show.
Well, thank you for watching Markets with Santo and CJ, and also continue to give in your feedback as well as any queries. We'll be happy to address them.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again Monday morning at 9 a.m. Till then, have a great day and great weekend.